In the financial world, there is a single Greek letter that separates the ordinary from the exceptional: alpha. It is the return a manager generates above the market, the proof that skill, not luck, drives the money. And selling that promise has built one of the most exclusive industries on earth. As of 2023, hedge funds collectively managed roughly $4 trillion, a sum larger than the annual output of most nations. The people who run them command respect, envy, and fear in equal measure. Names like Ray Dalio, Ken Griffin, and Stephen Cohen became billionaires, not by building factories or inventing products, but by moving capital with precision and nerve. The doors to this world are deliberately narrow. You cannot simply walk in and invest. United States regulations restrict most hedge funds to accredited investors. Individuals earning at least $200,000 annually or holding a net worth exceeding $1 million excluding their home. This exclusivity is not an accident. It is the product. The rich are told they are gaining access to strategies unavailable to ordinary savers, opportunities hidden behind velvet ropes. A pension fund managing retirements for teachers, a university endowment guarding centuries of donations, a family office protecting inherited wealth, all are drawn by the same magnetic pull. They believe that somewhere inside these secretive firms sits a mind capable of reading markets others cannot. And so capital flows upward, from the cautious to the confident, from the many to the few. The manager who can credibly claim to beat the S&P 500 becomes a gatekeeper of fortunes. But alpha is elusive. Most funds, studies repeatedly show, fail to outperform simple index investing over long stretches. Yet the belief persists, powered by the handful of legends who did deliver spectacular numbers. That belief is the foundation of everything that follows. The fees, the leverage, the machinery, the risk. Before a single trade is placed, before any strategy is deployed, the entire edifice depends on one act of persuasion. The manager must convince the wealthy to hand over their money. And that act of raising capital is a performance all its own. Before a hedge fund can trade, it must be filled. And filling it means courtship, an elaborate ritual of persuasion aimed at the guardians of institutional money. The targets are specific. Public pension funds like CalPERS, which manages hundreds of billions for California workers, university endowments like Harvard's, exceeding $50 billion, and family offices, the private investment arms of dynasties who never appear on rich lists. These are not impulsive investors. They demand evidence. The centerpiece of the pitch is the pitch book, a glossy document, often 40 pages long, that presents track records, biographies, and strategy. It shows historical returns, ideally beating the benchmark, and highlights the credentials of the team: former Goldman Sachs traders, MIT physicists, Wharton MBAs. Every chart is designed to signal one thing, that this manager sees what others miss. Then comes the due diligence. Institutional allocators send analysts to inspect the firm, interrogate the strategy, and probe for risk. They ask how the fund performed in 2008, in March 2020, during moments of chaos. They study the fund structure, its custodians, its auditors. A single, unexplained gap can end the conversation. What the manager is ultimately selling is trust. To hand over $50 million, $100 million, sometimes $1 billion, requires an almost irrational confidence in another human being. The investor cannot watch every trade. They cannot verify each decision in real time. They must believe. Regulations reinforce the exclusivity. In the United States, funds relying on the 3C7 exemption can accept only qualified purchasers, those holding at least $5 million in investments. This creates an illusion of privilege. If you are allowed in, you must be sophisticated. And if you are sophisticated, you can handle the risk. Minimum investments frequently start at $1 million, sometimes far higher. Lockup periods trap the capital, preventing withdrawal for 1, 2, or 3 years. The money, once committed, cannot easily flee. And with hundreds of millions secured, the manager holds enormous power and a guaranteed income stream. Because before generating a single dollar of profit, the fund already charges its investors. The mechanism is deceptively simple and famously lucrative. The formula is so iconic it has become industry shorthand. 2 and 20. 2% of assets under management charged annually, plus 20% of the profits. Two numbers that quietly built more private fortunes than almost any compensation scheme in modern capitalism. Consider the mechanics. A manager overseeing $1 billion charges a 2% management fee. That is $20 million every year, regardless of performance. Whether the fund soars or stumbles, whether the market crashes or climbs, that $20 million arrives. It pays salaries, rent, technology, and, crucially, it enriches the manager before any investor sees a gain. The performance fee is where the real wealth concentrates. If that billion-dollar fund earns a 20% return, $200 million in profit, the manager keeps 20% of it, $40 million. Combined with the management fee, the manager collects $60 million in a single year, while the investors keep the remaining $160 million, minus the fees they paid. On paper, both sides prosper. But the asymmetry is subtle and profound. The 2% is guaranteed income divorced from success. A manager can lose money and still bank tens of millions. Over a decade, a large fund's management fees alone can total hundreds of millions, extracted whether or not the promised alpha ever materializes. Investors demanded protections. The high watermark ensures a manager cannot charge performance fees on the same gains twice. If a fund loses money, it must recover past losses before collecting performance fees again. Some funds add a hurdle rate, requiring returns to exceed a benchmark before the 20% applies. These provisions sound reassuring. Yet the management fee remains untouched, flowing regardless. Critics have long argued that 2 and 20 rewards asset gathering over actual skill. The larger the fund, the larger the guaranteed fee, incentivizing managers to accumulate capital rather than generate returns. In recent years, competition has softened the numbers, 1.5 and 15 even lower. But the underlying logic endures. To justify these fees, managers must appear to possess an edge. And that edge, they claim, comes from tools ordinary investors cannot wield: borrowed money, bets against companies, and contracts of dizzying complexity. Hedge funds earn their name and their fees from an arsenal most investors never touch. The first weapon is leverage, borrowed money used to amplify positions. A fund with $100 million in capital might borrow another $300 million from prime brokers, controlling $400 million in assets. If those positions rise 10%, the fund gains $40 million, a 40% return on its own capital. Leverage transforms modest moves into spectacular results. But the same multiplier works in reverse. A 10% decline erases $40 million, wiping out nearly half the fund's equity. Leverage does not create skill. It magnifies whatever exists, brilliance or catastrophe. In 1998, long-term capital management, run by Nobel laureates, leveraged itself so heavily that a Russian debt default nearly toppled the global financial system, forcing a Federal Reserve-orchestrated bailout of nearly $4 billion. The second weapon is short selling, betting that a stock will fall. A manager borrows shares, sells them at today's price, and hopes to repurchase them cheaper later, pocketing the difference. It allows funds to profit from decline, from fraud, from collapse. But shorting carries unlimited risk. A stock can rise infinitely, and losses climb with it. In January 2021, funds shorting GameStop were caught in a short squeeze, hemorrhaging billions as retail traders drove the price upward. One fund, Melvin Capital, lost roughly 50% that month and eventually closed. The third weapon is derivatives, contracts whose value derives from underlying assets. Options, futures, and swaps let managers make enormous bets with limited upfront capital, hedge existing positions, or engineer exposures impossible in plain markets. A single credit default swap can wager on the survival of an entire company or country. Together, these tools embody the promise and peril of the industry. They can generate returns unattainable through ordinary investing, and they can annihilate a fund in days. Wielding them demands more than intuition. It requires analysis, models, and an infrastructure that runs relentlessly, scanning markets for edges measured in fractions of a percent. Behind every celebrated manager stands an unseen apparatus, a machine of people and code engineered to find the trades before anyone else. The public imagines a lone genius, a single mind divining the market's next move. The reality is an industrial operation, a machine of specialists working in concert, most of whom investors never meet. At its front lines sit the research analysts. They dissect companies, reading earnings reports, modeling cash flows, interviewing suppliers and competitors. A fundamental analyst covering retail might visit stores, count foot traffic, and scrutinize inventory to predict a quarter before the numbers are public. Their job is to convert information into conviction, to find the mispriced asset the rest of the market has overlooked. Alongside them work the quants, mathematicians and physicists who translate markets into equations. At firms like Renaissance Technologies, whose medallion fund reportedly returned an average of 66% annually before fees for decades, human intuition is replaced by algorithms parsing terabytes of data. They hunt for statistical patterns invisible to the naked eye, patterns that may persist for only seconds. Then come the traders, executing decisions with precision. In high-frequency operations, speed is measured in microseconds, and firms spend fortunes on fiber optic cables and microwave towers to shave milliseconds off transaction times. A single latency advantage can be worth millions annually. Underpinning it all is technology. Data feeds costing hundreds of thousands of dollars per year stream from Bloomberg terminals. Satellite imagery tracks oil tankers and parking lots. And credit card transaction data reveals consumer behavior before official statistics. Some funds employ alternative data teams whose entire purpose is buying and cleaning obscure information nobody else is connected. This machine is expensive. Salaries for top analysts reach 7 figures. Quants command bidding wars with technology giants. Infrastructure, data, and servers consume tens of millions annually. The 2% management fee, once it seemed like pure profit, increasingly funds this sprawling engine. And the engine never rests. Markets in Tokyo, London, and New York demand constant attention. Ideas must flow continuously, because a fund is only as good as its next trade. Yet running this apparatus legally, within the rules of regulators worldwide, carries its own enormous price. Beyond the traders and the code lies a quieter, costlier department, the one that keeps the entire operation from breaking the law. Behind every hedge fund's glossy performance sits a machine of paperwork. And it is not cheap. After the 2008 collapse and the Bernie Madoff scandal exposed in December of that year, regulators tightened the screws. The Dodd-Frank Act of 2010 forced most advisors managing over $150 million to register with the Securities and Exchange Commission. Suddenly, a fund could no longer operate as a private club with a spreadsheet and a handshake. It needed infrastructure. A modern fund employs a chief compliance officer, often earning $250,000 to $500,000 a year, whose only job is to keep the firm out of prison. Below them sit teams filing Form PF, monitoring trades for insider trading red flags, and archiving every email, phone call, and Bloomberg chat for years. Outside law firms bill $800 to $1, $500 an hour, to review marketing decks and confirm that a pitch to a pension fund does not cross a regulatory line. Then come the audits. Independent accountants verify the fund's stated net asset value because after Madoff invented $65 billion in fictional returns, no investor trusts a manager's own math. Prime brokers, administrators, and custodians each take their cut for holding assets and clearing trades. A small fund with $200 million might burn $2 to $4 million annually just to remain legitimate before a single dollar is invested. These are fixed costs. They do not shrink in a bad year. A fund losing money still pays its compliance officer, still files with the SEC, still funds the annual audit. This is why scale matters so brutally in this industry. A $10 billion fund absorbs the same regulatory burden as a $300 million one, but spreads it across a mountain of assets. For the small player, compliance is a slow bleed that can outlast the strategy itself. And yet oversight cannot manufacture returns. The regulators watch for fraud, not failure. A manager can be perfectly legal and still be losing to the market every single quarter, which raises the question that haunts every trading floor from Greenwich to Mayfair. What happens when the numbers stop working, and the investors start asking why they're paying so much to underperform? In the hedge fund world, the past is worthless and the present is everything. A manager who returned 40% last year is only as good as this morning's positions. The benchmark is the S&P 500, and beating it is the entire justification for the fees. When the index climbs 20% and your fund gains 8%, you have failed, even though you made money, because an investor could have bought a Vanguard index fund for 0.03% and outperformed you at a fraction of the cost. This is the trap. Managers are judged quarterly, sometimes monthly, on numbers they cannot fully control. A single bad quarter triggers awkward calls from pension trustees. 2 bad quarters and the redemption notices begin arriving. Because hedge funds report to investors on a schedule, every 3 months becomes a public exam. In 2018, Bill Ackman's Pershing Square had bled roughly $4 billion on a disastrous Valiant Pharmaceuticals bet and a losing Herbalife short, and investors fled, shrinking the firm's assets dramatically. The pressure warps behavior. Managers chase crowded trades to avoid looking different, because being wrong alone is fatal, while being wrong alongside everyone else is forgivable. Some quietly increase leverage to juice returns before a reporting date, a practice known as window dressing. Others hold losing positions too long, unable to admit a thesis has broken. The psychological toll is immense. Traders speak of the 2 a.m. dread refreshing Asian markets, waiting to learn whether a position moved against them while they slept. A star manager's reputation, built over 15 years, can crack in 90 days, and reputation is currency. It is what convinced a $30 billion endowment to wire money in the first place. Investors in hedge funds typically face lockup periods and quarterly redemption windows with 30 to 90-day notice. But once that window opens and confidence has evaporated, the exits stampede, redemptions feed on themselves. To pay departing investors, the manager must sell assets, often the best and most liquid ones first, weakening the fund for those who remain. That is how a firm, once called untouchable, begins to unravel, sometimes in a matter of days. Collapse in the hedge fund world does not arrive slowly. It detonates. The classic example is long-term capital management, founded in 1994 by John Meriwether and staffed with 2 Nobel Prize winners. By 1998, it controlled positions with a notional value exceeding $1 trillion on roughly $4.7 billion of capital, leveraged at ratios above 25 to 1. When Russia defaulted on its debt in August 1998, the fund's models broke. It lost $4.6 billion in less than 4 months. The Federal Reserve organized a $3.6 billion bailout by 14 banks to prevent the wreckage from taking down the global financial system. The mechanics of collapse are always the same. Leverage magnifies a loss until it breaches the terms lenders set. The prime broker issues a margin call, demanding more cash immediately. To raise it, the fund sells assets into a falling market, pushing prices lower, triggering more losses, more calls. Meanwhile, investors sensing danger file redemption requests all at once. The manager must return capital he no longer has in liquid form. In 2021, Archegos Capital, run by Bill Hwang, imploded in a matter of days, losing more than $20 billion and inflicting roughly $10 billion in losses on banks like Credit Suisse and Nomura through hidden derivative exposure. Amaranth Advisors lost $6.6 billion on natural gas bets in a single week in September 2006. The speed is what stuns outsiders. A firm managing billions on Monday can be liquidating by Friday. What vanishes first is trust, and trust is the only thing holding the whole structure together. Employees scatter. The research teams, the quants, the compliance officers, all gone. The gleaming office is subleased. The name becomes a cautionary tale whispered on trading desks. And here is the cruelest detail investors rarely absorb until it is too late. When the fund evaporates, they lose their capital, sometimes most of it. But the manager, in almost every case, walks away having already collected years of fees on money that no longer exists. The losses belong to the investors. The earnings belong to the manager. Which brings us to the final, uncomfortable truth of this entire business. Here is the arithmetic nobody puts in the pitch book. Under the 2 and 20 structure, a manager overseeing $2 billion collects $40 million in management fees every year, whether the fund gains 30% or loses 15%. That money is charged on assets, not on success. It arrives regardless. In a good year, the performance fee stacks on top. 20% of gains, potentially hundreds of millions more. This is the asymmetry. The manager participates fully in the upside, but bears almost none of the downside. When the fund loses money, the investor absorbs the full loss of capital. The manager simply earns less that year. He does not write a check to make investors whole. His personal fortune, already extracted through fees in prior years, remains untouched in his own accounts, his own real estate, his own foundations. Consider the high watermark, sold as investor protection. It means a manager cannot charge performance fees until he recovers prior losses. Sounds fair. But when a fund is deep underwater, and the high watermark feels unreachable, managers frequently do the rational thing. They close the fund, keep the fees already collected, and open a brand new fund the following year, resetting the clock at zero. The losing investors are left behind. The manager starts fresh, fees flowing again. Study after study confirms the pattern. Over the long run, the average hedge fund has struggled to beat a simple, cheap index fund after fees. Research by economists like Simon Lack argued that from 1998 to 2010, hedge fund managers and their intermediaries captured the overwhelming majority of the profits the industry actually generated, leaving investors with a thin sliver. The capital came from pensions, endowments, and families. The risk stayed with them, the rewards concentrated at the top. So when you strip away the leverage, the derivatives, the research floors, the compliance officers, and the mystique of alpha, one structural fact remains. The fees are charged before the returns are earned. The income is banked before the outcome is known. Whether you finish rich or ruined, the man managing your money has already been paid. In the economics of owning a hedge fund, the manager wins before you do.